and help you pick the right stock at the right time. Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts then. Sangeet, Lakkar of Newberry Capital, Vineeta Sharma of Narnolia Financial Advisor, and T.S. Harihar of HRBV Client Solution join me on the show. Good morning to all of my guests. Today on Hot Money, we'll discuss Lemon Tree, a big deal that happened in terms of an alternate business that they had. The counter did manage to rally on Friday. We asked our guests whether the rally will continue. NBCC has actually rallied more than 10% in the last two trading sessions. What's keeping NBCC up? That's something that we want to ask. Metal stocks of late, is this the right time to accumulate? Because most of the metal stocks have fallen significantly. And since we are at the cusp of a new year, which is the top pick that they believe should investors accumulate for a matter of 1 year. So those are the stocks that we'll discuss in today's edition of Hot Money. Let's start with the first stock. The first stock is Lemon Tree. Obviously, the deal with Warburg Pincus in terms of shared spaces is something that they have invested. So 1,500 crore initial phase, and then the joint venture will be almost 3,000 crores. But what's the view on the hotel industry and Lemon Tree in particular? We'll ask our clients. So Hari, recently listed, so not too much of history in Lemon Tree, but the hotel industry is not widely tracked, and not a lot of companies have done well. Lemon Tree seems to be doing well, at least stock price wise, of the last few days and the recent development that happened. What's your view on Lemon Tree?
I think the Warburg deal is probably more of a, I would say, ratification of the attractiveness that the stock has. And I think what we have seen in the last few, probably, I would say, couple of years, is that it's a very distinct shift from going to full-service hotels into what I call more of the budget hotels, which is what Lemon Tree basically deals with. And, you know, also, if you look at the New Year, I was just checking out some of the New Year packages. In fact, there is a huge demand, you know, which has gone away from the regular hotels to these kind of, you know, budget hotels that are run by Lemon Tree. So I think from that perspective, yes, probably, like I always said, you know, that the general Janta model works well for airlines. It's probably what is going to work better for the hotel industry also. And one of the reasons the hotel industry didn't do very well was that listed stocks were probably still, I would say, more in the premium space rather than the general space. And Lemon Tree probably is one hotel company, listed company, which offers you offerings which are more in the middle to upper middle kind of a segment. So I think from that perspective, we like Lemon Tree. And I think the Warburg deal was probably good, because for a stock that doesn't have too much of a track record, I think a deal like Warburg does ratify its valuations at these levels.
So do you advise your clients ever to get into the hotel industry? Because one of the concerns that, you know, people generally have is that, you know, most of the hotel industry stocks haven't made that much money because debt is a big concern on them, and it's a big capex industry. But would you advise you know, investing in Lemon Tree or any other hotel stock as such?
See, if you look at the last 1 year, I think there are certain hotel stocks like EIH that have done quite well. So it's not like hotel stocks haven't done well. But as you rightly said, the problem with the hotel stocks generally has been that capital expenditure is huge, and it takes a long time for them to recover. So only once the capital investment is done and the returns start coming in, that's when you actually start seeing these hotels moving up. But as I said, no, my pick on Lemon Tree is more because they are focusing on the mid segment, and I think that is probably where the real explosion in demand is going to come.
Okay, Vineeta, you agree about hotels? Do you all have any hotel stocks under active coverage, and what's your view on Lemon Tree?
So we do not have any hotels under our active coverage, but yeah, we do have soft coverage on a couple of them. And regarding Lemon Tree, obviously, you know, the hotel industry as such, they're doing good because the occupancy of late has grown up. And if you remember, you know, 2005-06, where the hotels did a good run up. So that was the time when the top line was much more, and it was most of the expansion were over. So that time when they got into another phase of expansion, which caused the you know, all these hotel companies to stay back from price appreciation for a long period of time. So that time asset turnover was very huge.
Okay.
So at this point of time, if we see any hotel industry, so we are seeing run up in the turnover, which is justifying little bit on the asset turnover, which has gone down because of the asset that they had acquired in the books. As regards Lemon Tree, occupancy is going up. ARR is rising, best geography mix, it is best. So overall business wise there is no problem. Definitely if you look at the financials, so financials will follow henceforth, and I think it will be a longer period of time. So the price appreciation has not much as such. Our post listing it is down only, but then I don't think this price appreciation will be too high in a very short period of time, because if you look at the top line, there is around 400 crores of top line, and 1/4 is into operating cash flow, so which is pretty good. But then they are obviously adding debt, and the overall the whole cash that they are generating is going into investing. So more than, say, if there is 140 crore of cash flow, operating cash flow, there is 260 crore of investment. So that ways it asks us to stay on a back foot, because bottom line is compressed by the interest charges and depreciation and stuff. So if somebody has a very long-term perspective, they can stick on with the with Lemon Tree, but I will not advise. Which are the stocks that you have under soft coverage, the hotel stocks? So we have Indian Hotels, we have EIH. Okay, and so but still we have not asked anybody to go aggressive on any of the stocks. Okay, Sangeet, have you all recommended to your clients any of the hotel stocks, or would you prefer to stay away?
No, so very positive on Lemon Tree. Okay. So hotel industry, if you see, it has a 7-year cycle. So the last cycle ended on 2007-8, where the capacities far exceeded the demand. Lemon Tree has been the only player who has been adding capacity during last 5-6 years. No other hotel chains have been adding capacities. They have their utilization much higher than the industry rates as well. And as you mentioned, I also am positive on the mid-size and the budget hotel space. I don't think debt is a big problem. They have about 1100 crores of debt. The management is guided that this is the peak that they will be having. They have outlined a very clear-cut capex of reaching 8,500 rooms by FY22, and that's when they also become debt-free. So, and a huge operating leverage kicks in when the occupancy rates increase, because your pricing improves, and a sheer operating leverage due to the occupancy increase. So remain very positive on Lemon Tree. Okay, Lemon Tree is something that I think two of our guests do believe it's positive to enter Lemon Tree at this point of time, and that's the view on the entire hotel industry. The second stock, and that is NBCC. Of late, remember, NBCC has corrected significantly from the highs that it was, but over the past few days it has been rallying. It's down almost 50% on a 12-month basis. So there were obviously some concerns, especially one big project that they had, in which they were not getting any kind of approval that is there. But is this the right time to start accumulating NBCC? That's something that we'll ask. Vineeta, any view on NBCC? Yeah, NBCC valuation wise, it is attractive right now, and anybody who wants to get into infra space can get into the stock. There are certain concerns, like what you said, the environmental concern that the company was facing, but that is over for now. And two things. One is Amrapali projects that they are taking for 46,000 units, which will be investment of 8,500 crore. And secondly, the JP Infra acquisition they might get into, and JP Infra has around 10,000 crore of debt. So NBCC, as we have seen in the past, is a debt-free company, which and that's the reason for its high valuation in the past. But then I mean, with all these acquisition, how the balance sheet would pan out will be an important thing to watch, because that will be the key driver as to how the valuations will move going forward. As of now, if we look around, it's trading around, it has a 16% ROE for FY20. And the price to book is around 4.4 or something. So valuation wise, it is attractive. There is good order book, around 80,000 crore of order book, which fares well. So good amount of top line growth that we can expect for NBCC going forward. Okay, Sangeet, NBCC of late, till at least last year, was one of the best performing government companies, but then suddenly everything went downhill again. What's your view on NBCC? Should you invest, or a government company concern is there on the company? So as a matter of policy, I always say I avoid PSU stocks, and the same goes for NBCC also.
I think recently they got some environmental clearances for their Delhi unit. That's why I think there was some rally. But otherwise, if you see even over a 10-year trajectory, the margins have always been in the 4 to 6% range. You know, it's a very thinly, thin margin business. The working capital are pretty stretched. The ROE looks high, but that's because they have a capital light model. You know, it's not because of that they are efficient, sort of. So, and valuation is not cheap. I don't think even despite the correction, the valuation is cheap. So I would stay away from NBCC.
Okay. Any other concerns as such on the company?
There's no concern as such, but as a matter of policy, I don't invest in government stocks.
Okay, so fair enough. Hari, what's your view on NBCC?
We like it. I would agree with most of the concerns that Sangeet expressed. But I think the only thing is that in terms of a valuation point, I think the price point looks very attractive, especially after the correction. I have only one concern, and that is the JP. We would be very happy if the JP deal doesn't go through, because what happens is once JP comes in, there is a huge debt that comes onto the books. And once the debt comes in, it destroys the entire debt equity structure as far as the company is concerned. So NBCC, I think if you look at it purely in terms of business volumes, there's a huge infra investment coming. NBCC is a zero debt company, so they have the potential to operate an asset light model very, very effectively if they don't take over a high debt company like JP Infra, because I'm not sure what is the kind of value add that the JP Infra can really bring to this company. So if they don't take over JP Infra, I think the price point is very attractive to buy NBCC at this level.
What's the key drivers for NBCC? Leave aside the valuation that you've spoken about and this deal that hasn't come through. What do you like about the company?
See, basically, I think it's more of a macro growth story, because if you look at roads, if you look at the kilometers that are being put on a daily basis, I think it's far, far superior to what it was probably 5 years or 6 years back when the UPA government was in power. So in that sense, yes, I think NBCC has a huge traction available to it in front of it. Environmental concerns, yes, that has always been a concern with these kind of stocks, but I think the macro growth is what is going to actually drive the stock.
Okay, so that's the view that's coming in. Two of our guests like NBCC at this point of time. Sangeet, as a policy, does not invest in any kind of PSU stocks. The next one is the metal stocks, and most of the metal stocks have actually corrected significantly. We saw a little bit of green shoot as far as price recovery is concerned over the past few days, but is it here to stay? What's the view on metal stocks? Because if you see what has happened on a 12-month or a YTD basis, on the metal stocks on the LME, the commodities as such, they are down anywhere between 10% to 25%. So the cut has been there. There's not even a single commodity which has gained in this year's concern. So the base metal itself is down significantly in trade, and you can clearly see for the past two, except for the JSW Steel, all the other companies have given a negative return. Sangeet, are you all recommending metal stocks to any of your clients?
Not really, actually. So metals again is a very highly cyclical business. And the right way to play cyclical business is that you have to buy at the bottom of the cycle and possibly get out, at the right time. I don't think metals as a pack is at the bottom of the cycle. China is slowing down, given for a fact, and China has been the biggest consumer of metals as well as producer. US is also slated to slow down next year. So I would stay away from metal stock as a whole. There is an exception. I like Jindal Steel because they are more domestic focused. They are into long products, used largely in railways and stuff like that. So, but otherwise, as a pack, I remain cautious.
Okay, so they've on JSPL, just they had come out with this entire restructuring activity they had spoken about in terms of listing of the Oman assets and then keeping the power business separate. Do you think that makes sense? Is that something of a positive trigger for the company?
So I am not aware of the fine tunes which has come out.
But this was a while back, not.
Yeah. But then again, Oman forms a small portion of the overall entity. I think after their Angul expansion, they are ramping up capacities pretty, on track. So there is a fair bit of operating leverage which will come into the numbers. So the debt looks optically high, but if you see the numbers that will flow through, that will easily justify the debt that they have taken.
Okay, Vineeta, which among the metal stocks are you all pushing to your clients?
So, Darshan, the way we are looking at metal stock right now is they are at their cyclical low valuations right now with all the corrections. So, there could be two sides to it. One is, the earnings get deteriorated going on. So, in the hindsight, again, you will find the valuation was justified. Or the price rises from here. Now, regarding earnings, if we look at the non-ferrous side of the metal side, So there are a lot of global issues that is going on, and to take a one-year call and to be have a long-term view, it's a little difficult. On the ferrous side, it still becomes easy because most of it, say on the steel side, becomes easier because it's more, domestic focused. So in that case, if somebody wants to get into a metal stock, I think JSW Steel could be one pick. And last time we had spoken about one high risk, high gain stock in which we have mentioned about Jindal Steel also. So JSW Steel, if we see the valuations are around 6.7 EV upon EBITDA, and in 2016 around it was trading around 10 times EV upon EBITDA. So valuations wise it's okay. If we look at the acquisition that it has done in the past, so most of the volume, so for the next 2 years we're not seeing too much of a volume growth in JSW, but yeah, going forward from FY20 on end of FY20, we'll see volume growth ramping up from the acquisitions also. Regarding the cost side, so even JSW, they have added up mines which are ramping up. So I think there are several cost initiative actions that the company is taking. If earlier they used to from the mines the raw material used to go through trucks and stuff, so they have put a conveyor belt through which, so these are small, even the iron ore mines that they are that they have added one more, so now the total mines is around 6 for them. So there are several cost effective measures that the company is taking to protect the margins. So I think JSW should be one stock where the balance sheet is also proper in shape, and valuations are also not very costly. So that could be one stock.
I think my only question here is that so it seems that you like the steel stocks among the other metal plays, but if we see the spread has come down because China prices have come down while the raw material prices have gone down. Is falling spread a concern that you would have at this point of time? Yeah,
so falling spread is definitely a concern. So in that case, that's the reason we are liking JSW, because it has this cost initiative structures very well placed.
Okay.
So that will give the advantage if you consider on a peer group analysis. So it will have that advantage. Volume growth, see, the bottom line has shot up from 5,000 crore to now 9,000 is what we are expecting within a span of 2 years. 30,000 crore top lines, we have come to around 80,000 top line for FY20. And so overall the balance sheet structure, the return on equity is around 16 times. So the metal stock, for such a big metal stock, having a stronger as well as stable P&L is a difficult thing to watch. So I think in that space, having that stability, considering both these things, JSW is definitely a better.
Okay, Hari, and what about the metal stocks? What do you like in the metal stock as such?
No, we are off non-ferrous, so no aluminum or copper for us. But I think I would agree with both of them. And steel probably looks to be the best bet. And let me tell you why we are negative on the non-ferrous part, because largely that is a function of China demand. China accounts for more than 50% of any of those non-ferrous metals that you take up. And we believe that 2019 could see two things. One, the so-called inversion of the US yield curve could actually result in a slowdown in demand both in the US and in China. So we are a little skeptical about non-ferrous demand. So 1920, I think, is going to be tough years for these kind of stocks. So any aluminum, copper stocks, we are out. If you look at steel, I think steel, the entire industry is getting split across 4 groups. And there is SAIL, there is Jindal, there is Tatas, and now there is the Agarwals of Vedanta, which has come via electro steel route. So I think if you add up all these, you're still having a huge shortfall as far as the demand 10 years down the line is concerned. So there is a big opportunity, and I think even though, as you rightly mentioned, the spreads have narrowed, I would believe the top line growth should probably more than compensate. And anyway, most of the stocks have a take Tata Steel. I think it's correct for about 200 rupees from the peak. So most of the stocks are giving good price entry points, and with Tata Steel also probably reducing their focus on Europe, giving it to Thyssen, and then focusing more on India, I think Tata Steel and JSW could be 2 stocks to watch out for.
Okay, what are the triggers? You spoke about Tata Steel's trigger. Why do you like JSW?
Both Tata Steel and JSW we like largely because if you look at the capacity that they have, I think 20 million plus tons, they are probably the two companies that are going to be likely to benefit the most from the growth in volumes. I keep saying that if you ask me to take a pick, I won't select steel, I would probably select the arc furnaces, so like the likes of Graphite India, but that's, let's leave that out for the time being. But I think if you look at pure top line growth, I think JSW and Tata Steel could be the two major beneficiaries.
Okay, so I think among the metal space, I think it's the steel stocks that have actually found focus among our experts, and since it's the start of a new calendar year from tomorrow, we are asking our guest which is one stock that they would recommend as the 2019 pick, which actually someone can buy and hold for a matter of 1 year. So Hari, which stock do you believe could be the outperformer in 2019?
I think SBI could be the dark horse. The stock has not gone anywhere in the last probably couple of years, but I think a lot of things are going the way of SBI. Number one, I think after 3 consecutive quarters of losses, there was a profit in the last quarter. So at least I think the NPS cycle seems to be bottoming out. It's still going to be a long way before they can get over the NPS cycle, but at least the cycle seems to be bottoming out. Second, I think the capital infusion that has come in, that should, I think, put the capital basis of all these PSU banks on a much better footing. But I think more importantly, if you look at it, about 70,000 crores came back from NCLT in this year, and roughly about 110,000 crores is expected next year. So that's going to be a lot of cash flows that are going to come back and improve the debt creation capacity of these banks. So I would believe that SBI at the current valuations, substantially at a discount to probably a Kotak Bank or a HDFC Bank in terms of price to book, I think SBI could probably be the stock to watch.
Yeah, but they always trade, PSU banks always trade at a discount given the fact that the concerns they have compared to a retail focused private bank, and SBI is no exception, because dark secrets keep on coming out of the closets every few quarters. When the management keeps on saying that the worst is over, somehow it doesn't.
See, what we hope is that SBI may not have skeletons in the cupboard like PNB had. I'm hoping that doesn't happen. I think that's unlikely to happen. But having said that, while I agree with you that the discount of about 3 to 4 percentage points that exist for a long time, I would believe that gap has to gradually narrow. At some point, I think investors need to realize that you're almost getting most of these PSU banks at dirt cheap rates. So 2 years back, yes, NPA was a problem, growth was a problem. I think we are gradually getting out of it. That's why I said it could be a dark horse. I'm not saying it's a great bet. It's a dark horse that could have come in the next year.
Okay, Vineeta, what about you? Which stock are you pushing to your clients as the stock of 2019?
So we're liking Canfin Home. Okay. And Canfin Home, if we see, the asset growth had narrowed quite a lot because of RERA being slow in implementation in the home state, and now we are seeing a good amount of advanced growth coming in for Canfin Home. Regarding the liquidity crisis and everything, I think Canfin Home has a good parentage, and so there will not be much of a crisis for Canfin Home. Also, it has been able to raise funds in between these periods, so that gives us a confidence of the good parentage the Canfin Home has. Regarding the spreads, so if we come at if you look at the yields have started to increase because the products interest rates have been increased by the company. And regarding the cost side, if we see, the company is able to refinance through NHB. So again, we'll get a good amount of spread, which we expect that it has bottomed out for now. So asset quality is in shape. Asset growth is what we are seeing. NIMs are not expected to fall anywhere from here. It's expected to rise from here. So I think it's done away with most of the fall it had to, and it should be a good bet.
Okay, what's your view on the valuation, and do you believe that the concern that people had in the housing finance companies, given what we've seen in the real estate place where offtake is not happening, is that a valid concern not to play the housing finance business?
So we were negative or say neutral in the housing finance segment for quite a long time, but then if we look at the overall scenario right now, because the main concern was competition. So growth, okay, for some time it has lowered, but then it should pick up. If you consider the long-term structure of India, so I don't think there is any problem with the growth. So asset growth should happen sooner or later, which we have started seeing. But the NIM was major concern because the spread do not, especially on the cost side, it's not easy to have that refinancing very easily. Because and it takes some 2 to 3 years through which the whole spread thing plays out. Just the way we saw the spread moving ahead, it took some 2 years to get that thing in place. So I think where you're getting, there is not much concern with the asset quality parameter, as well as the NIMs are improving. I think it's a good bet to have.
Okay, Sangeet, what about you?
Yeah, so I'm presuming that 2019 means not a very long-term investing. So I've chosen a relatively small cap stock. It's a Goodrich Group.
Okay.
Okay. It's a tea company based out of Eastern India. Again, it's not a very long-term call, but I think over the year it should do well. So there are multiple levers for growth. The first opportunity is the Iran sanctions which has come on, wherein a similar sanction had come on in 2013-14 also. And India had a unique arrangement with Iran for importing oil with a payment mechanism with UCO Bank, which essentially means like a barter system of trade, and that's the time the rice exports and tea exports had got through the roof. So Goodrich has about 25% of its turnover in exports. They also did benefit during the last sanction regime. So this will be one kicker. They own about 17 tea estates in Eastern India. Okay. 2 of them are in Darjeeling, which are a very high yielding kind of a tea estate. The realizations have been about 50% higher than the next peer. So the focus has been on producing quality teas. If you see the domestic operation, the tea again has been about on an 8-year down cycle. Whereas during this last 8 years, the labor cost has gone up, but the realizations have remained stagnant for the industry. Despite that, the Goodrich Group realizations have increased in commensurate with the labor costs. But I think with now, with the cycle turning, this will be another advantage for Goodrich.
Okay.
Okay. So they had about 80 crores cash on books. It has always been a debt-free company, being an MNC. And during the current year, they have acquired 2 estates from McLeod Russell.
Okay.
And they have also bought brands from Godfrey Phillips. This will help in their packaging. So what essentially it will do is the 80 crores which was lying in the balance sheet and which was earning them treasury kind of returns will immediately be put to use to earn their 12 to 15% return of equity kind of returns.
Okay.
So that will be another kicker to the earnings. MNC company, very good quality management, best of the estates they have. And now let's look at the valuations also. So they bought the tea estates from McLeod Russell in the current year at about 348 rupees a kg. So generally the tea estates are sold as a tea production capacity of the estate. Okay. Even if I assume 350 rupees a kg kind of yield for their 17 estates, essentially, if you go to see, because they have estates in Darjeeling, the price would be much higher. So even if I value it on a liquidation value principle, the intrinsic value of the company is much higher than their current market price.
Okay.
So that also gives a lot of comfort on the valuation bit. On the concerns, obviously, it's not a very actively traded stock. It's only listed in BSE, so it suits kind of an retail investors' appetite. But yeah, I mean, it looks a good bet for 2019.
Okay, many thanks for that. So the 3 stocks of 2019, which our guests have indicated, include SBI, Canfin Homes, and Goodrich Group. That is something that you need to watch out for. But with that, it's a wrap on today's edition of Hot Money. Hari, Sangeet, and Vineeta, thank you so much for coming into the studio for the show. Ask BQ comes up next. Stay tuned to Bloomberg Quint.